Hey guys, I'm Becky and welcome to my channel. So today we're going to be continuing on with our retirement accounts and planning for retirement. So today is going to be focused all on what is exactly a thrift savings plan, a TSP. So a thrift savings plan is specifically for federal government employees or military service members. It's a defined contribution plan, meaning there's no fixed monthly benefit at the end of it. You're not going to go through retirement and have a set $200 a month for the rest of your life. It's only going to be what you put into it and whatever employer matching you have, and that's it. There's no set fixed benefit throughout your retirement. So that's the big thing with this one. Once you empty the tank, so to speak, there won't be anything left for you to use because it'll be empty. So you only get what you put into it. The good news about a TSP is that you automatically receive 1% of your salary just for simply being an employee and for working for the company, whatever government agency is, whether that is the armed forces or the FBI or whatever that looks like. You're going to receive a 1% of your salary just off the bat for doing nothing. And as of October of 2020, so just last year, they implemented an automatic enrollment for all new and rehired federal employees that put you automatically contributing 5% of your annual salary into the TSP. And this is a great thing. It's actually, if you look at the statistics of someone being more likely or higher likely to invest into their own retirement fund, having an automatic withdrawal set up the day they start is a phenomenal way to do that. So if you're a small business, you should think about doing that. And if you're not investing in your retirement, you should look at least getting that employer match, because that's what that 5% is of your annual salary for the TSP. So they offer, the federal government offers a 5% matching, so up to a 5% matching of your income. And so the first thing you have to do with that is, to get that 5%, is you get that 1% just for being awesome, just for being an employee, just for showing up in the right uniform at the right time at the right place every single day. So 1% off the bat, just like that. And then that's where we get into a little breakdown. So if you contribute 3% of your salary, the government, your agency, whatever it is, will match that 3%. 1% for 1%. So 100% dollar for dollar, they will match that 3% with another 3%. So you're at 4% and you're only putting in 3%. So fantastic money move right there. And then the last part of this is, if you go up to, you can do increments, but if you do another 2%, so making your combined total 5% of your annual salary, that last 2% that you put in, that government agency is going to match that 50 cents on the dollar. So for every dollar you put in, they're going to put in 50 cents. So if you do 2% plus, so if you do 2% plus the original 3%, so you're doing 5%, they're going to match you one base. Fingers are hard. So they're going to match you one base, three more for putting your 3 in, and then another % for you doing 2. So you're going to get 10% of your base pay, your salary, your yearly annual salary, 10% into your retirement account at 50% off, basically. So 50% of your money is free. So to break it down numbers wise, because I like numbers, so say you make $15 an hour, which averages out to $2,400 a month. So the government agency will contribute 1%, or $24 a month, just because you're awesome. And then you contribute $72 a month. And the government agency will contribute another $72 a month. Then to top it off, you contribute another $48, and they will contribute another $24. So rounding it out to $264 total, this is making $15 an hour, and you only had to contribute $144. So the remaining $120 by your government agency is a free gift towards your retirement. So for me, free money is something that I never want to miss out on. If it's there and it's on the table, I want it. It's basically them just walking up to you and go, do you want a 20? Oh, here you go, have a 20 for showing up to work. You're not going to turn that away, because who would turn away free money in that instance? And the good thing about having that automatic enrollment set up is that you're not going to miss it at all. It's going to start the day you start, and you can make changes to your contribution levels throughout any time during the year. So you can bump it up and you can go to 10-15% of your own income, or if you need to, you can adjust that down so that you're only taking 3% of your income. And that it's a great thing that you have that option and that ability, and you're still going to get that 1% no matter what you do. Even if you don't contribute a dime of your own money, you'll still get 1% of your annual salary courtesy of your federal agency. So the thing that I love about TSPs is, and I have one, I've had it, that was my first retirement account that I've ever started investing with. I started investing in the Thrift Savings Plan back in 2011 when I first joined the Army. And I've maintained that account this entire time because you could do that. The big thing that I love about it is broken down into two different ways that you can invest your money. So you have Lifecycle funds and you have individual funds. Now, individual funds are uniquely broken down into different like stock indexes and market segments. So they're focusing on a specific like niche inside of the stock market, inside of bonds, inside of treasury bill, whatever it is. It's focusing on a very specific area with each one of these individual funds. So there are 5 individual funds. We have G fund, we have F fund, we have C fund, we have S fund, and we have I fund. And they break down in a ranking of low risk to higher risk, and different percentages of returns that they've seen averaged out. So the G fund focuses completely on government-backed securities and is actually completely guaranteed by the federal government. Essentially, there's zero or no risk involved with this fund. The return rate is calculated by an average of more than 150 different U.S. Treasury securities each individual month. So you're seeing an average return rate of about 4.82% on G fund alone. Then you have F fund, and F fund focuses on fixed income index investment funds. It's very similar to the performance of the Bloomberg Barclays U.S. Aggregate Bond Index. So this fund follows that bond index and is only focused on high quality securities with a low to medium risk assessment. So F fund is averaging about a 6.18% return. It's averaging a low to medium risk assessment with it, so it's a pretty good investment. So C fund focuses primarily on matching the S&P 500 stock index, which is, if you haven't heard of this, then you probably don't know that much about investing in the stock market, because it's a very common index to follow. It's actually one of the most top rated and top followed indexes that is used to gauge the United States market overall, just because it's encompassing the 500 of the largest companies in the United States that are like publicly traded. So it sits at about a 10.8% return every single year. That's an average, and it sits at about a medium risk. So medium risk with a pretty high return rate on it. So that's a really good fund to focus on, especially if you're younger and you have more time to deal with the higher risk in that. And then S fund, which focuses on matching the Dow, the S fund. So the fourth one, S fund, which focuses on matching the Dow Jones Stock Index, which, while the C fund, which is the S&P 500, focuses mainly on those large companies that are well known and very established and just huge market share, the S fund focuses on the little guys, the smaller companies that aren't meeting that big market capital of the C fund. So you've got a different avenue of focus in the stock market and a different risk level involved with that. You're seeing a somewhat similar return between the two funds, the C fund and the S fund. The S fund is sitting at just over 10.25% annually, but it's a little bit higher risk because they're not as large of companies, they're not as established per se. So there's a little bit more risk involved with this and a little less return, but it offers you different areas of focus inside of the stock market when it comes to investing. And then the last fund is the I fund, which is an international based investment strategy. Basically, it focuses on matching the EAFE index, which covers the performance of international companies trading in the European, the Australian, and the Asian stock markets. So this fund offers a really big diversification for your portfolio if that's what you're looking for, and focuses completely on investments that are outside of the United States. They're not United States companies. It's a different avenue to approach. And because it's internationally, it's not in the US, and it's just a little bit different, it's a little bit higher risk than any other fund, and it has about a 5.16% return annually. So those are the 5 different individual funds. Now, it's really important to remember those 5 individual funds because those are going to be what comprises the Lifecycle funds. And the thing that I like the most about the Lifecycle funds is you can go and say, you know what? I am set to start my retirement, or I'll be retirement age eligible to withdraw funds in 2060. And so you can look at it and it breaks it down by years in 5-year increments on retirement, estimated retirement, or the estimated time you're going to withdraw funds. So you can literally go, oh, well, 2045 is when I'm set to retire, so that's the one that I'm going to pick. And it's going to automatically adjust and balance your portfolio, your own retirement portfolio, based on your age to go along with the risk. So the younger you are, the higher risk that you can take, the more involved in stocks and volatile markets that have higher returns. You can do that while you're young, because if something were to happen, you have so much time to be able to correct that and still generate and build up your retirement. So it goes down. So it starts off with L income, which is basically you are in your retirement phase, you're withdrawing funds right now, and its sole primary focus is just to keep your money there. It doesn't want to take big risks, you don't want to have a huge return, it's just maintaining money and hopefully better than inflation. So the income fund is actually seeing about a 2.39% return, and that's just very little to no risk at all involved with that. And then it just kind of escalates from there. So you have the L income, you have the L25, the L30, the L35, and it just goes all the way up to L65, to 2065, the estimated date. And it just increases in risk, the risk level from low to low, medium to high, and it also varies on the return rates, which you see generally increasing the farther you are away from retirement. So that means the closer that you get to retirement, it kind of moves down, that L fund, that Lifecycle fund moves down with you. So right now I think I'm sitting at like 2060, 2065 to retire. So I'm at high risk aspect of it. I'm getting a high return on it right now, and I don't have to do anything to those funds because it's going to automatically balance it out the closer I get to my retirement age, and with basically lower that risk level and invest it more towards bonds and those stable treasury securities that have basically no risk. So it's going to slowly transition away from the higher risk markets and into those more secure and stable with a ready income supply coming from it. So that's why I love the Lifecycle fund so much, because they are based out of those 5 individual funds that diversify your portfolio just for you and your age and your tentative retirement date. I think it's important to remember whenever you're looking at retirement and investing, you typically are going to have 2 different avenues that you can approach, and you have Roth and you have traditional contributions. So whichever you choose, whether you're going with the Lifecycle fund, or you can just pick your year and be good with it, or you're choosing to focus on your own diversification strategy with those individual funds, you're going to have to make the decision on whether you want to make your contributions as Roth or traditional, or maybe a mixture of both between the two. So by using traditional contributions, you're going to add more into your retirement pie right now, and you're going to defer paying your taxes until you actually get to that retirement age or when you start withdrawing this fund. So you're not going to pay taxes on it right now. You're going to save on taxes. You're going to put more principal in today, but you're going to pay taxes on the back end. With the Roth contributions, you're going to go ahead and pay taxes for it right now. So you're not going to have any tax savings. You're going to end up putting in a little bit less money into that end goal, that big pot at the end. But the good thing about Roth is that you're paying your taxes right now, but all of that money and all of that interest that you accrue over the years, when you go to withdraw that, it's going to be tax-free because you've already paid your taxes on the principal amount. So I really love Roth. I really love Roth. I personally have invested a little bit with both. So I have the majority of my money is towards Roth right now just because I am quite a few years away from being able to withdraw it. So the more interest that I accrue that is tax-free right now is fantastic. So unfortunately, with every retirement account that you're going to run into, there is going to be an annual contribution limit that is set up by the federal government and maintained by Uncle Sam. So for 2021 with the TSP, the total amount that you can contribute to an individual Thrift Savings Plan retirement account is $19,500. Now that's Roth and traditional combined. So total, that's all that you can contribute in 2021. There's a catch for that. If you are 50 years or older, there's a catch-up balance where basically you can put in an additional $6,500 towards your retirement. So $19,500 for under 50 and $26,000? Yeah, $26,000 for everybody that's 50 years and older for a TSP. So that allows you to make contributions and try and catch up because you're going to be closer to your retirement age, and that money, that value of the dollar you're putting in is going to be harder for you to save enough to retire the older that you get. The longer you put off saving for retirement, the harder that it gets. Go figure. If you can't max out your limits, make sure that you are at least putting enough in to get that employer matching to soak up all of that free money that they're giving you. So if you put in that 5%, you're going to get 5% free money towards your retirement. So at least try and put in that employer matching so that you're getting the most bang for your buck. 100%. I wish if I could pound this into your skull right now, just meet that retirement matching with your employer, get that free money, and just try everything that you can to set yourself up for success. So unfortunately, you can't just put in your money right now and 2 months later walk away with all the money that you put in and your employer put in. Most retirement accounts are going to have a vesting period, basically where you have earned your spot to retain that money. So with a TSP, it's actually only 2 years. So it's on the lower end of the spectrum for how many qualifying years of work you have to be able to walk away with that nest egg. So 2 years of federal service, 2 years in the military, whatever it might look like, those 2 years are all that you need to be vested. And then you can walk away with all the money that you've put in and all the money that your employer, the federal agency, has put in on your behalf for you. So that free money, you get to walk away with it after 2 years of service. And the TSP only has a minimum balance of $200 to retain your account permanently. So if you only have $200 in there, you can keep that TSP account and just let it grow for as long as you want to until you reach their retirement ages, and you don't have to do anything with it. You can just leave it there. And TSP allows you to actually roll over your other retirement accounts, your IRA, your 401k, your 403b. You can pull all of that in if it qualifies. There's a little caveat to that. It has to be qualifying. But you can pull that money in and put it directly into your TSP account and build your nest egg up in one spot. It's fantastic. I love that. The one catch with all retirement accounts, though, is that there are fees involved. It's not free for them to balance your portfolio and to transition your money basically towards your retirement age. That comes at a slight cost, but there's going to be fees and costs associated with any retirement account that you work with. Luckily, they're required federally required, legally required, to let you know what those fees are and what the actual cost is so that you have a clear picture of what you're working with. So while it doesn't weigh too heavy on the spectrum of what you're going to pay and what the overall approach is with it, you should have it on your radar, especially if you're looking at different retirement accounts, whether that's from a different employer that's not a federal agency or your individual retirement account. Whatever it looks like, you want to be able to basically shop around for the best bang for your buck. So take into account the account fees, the average return that you're going to see, how well is your portfolio going to be managed if you're not doing it yourself. So those are things to keep in mind when you're looking at that, and weigh your options to choose what is going to be the lowest and the most return for you. So with that, as long as you're putting something toward your retirement now, please do, you're going to set yourself up for success, because let's face it, time is on your side. Compounding interest is amazing. So if you put in a little bit now and you keep doing that consistently, you're going to build that nest egg up. So keep up the great work, guys. I'll see you next time.